In a recent report by the Federal Deposit Insurance Corps, FDIC, it has been revealed that the largest U.S. banks are experiencing their highest proportion of stressed loans in commercial real estate portfolios in over 10 years, reflecting a notable downturn in demand for office space. Let's dig into this topic: what commercial real estate loans are and what their impact would be if they fail. Don't forget to subscribe if you find this information useful. The current situation of stressed loans in commercial real estate is emblematic of the complex interplay between economic conditions, market dynamics, and individual borrower circumstances. At present, the largest U.S. banks find themselves grappling with a higher proportion of stressed loans within their commercial real estate portfolios than they have encountered in over a decade. One of the primary drivers behind this predicament is the subdued demand for commercial real estate spaces, particularly evident in sectors such as office space. Economic headwinds, including the lingering effects of recessionary periods or fluctuations in consumer behavior, have contributed to a scenario where the supply of commercial properties outstrips the demand. This oversupply dynamic exerts downward pressure on property values and rental rates while simultaneously prolonging vacancies. Moreover, certain sectors within commercial real estate face sector-specific challenges that exacerbate the situation. For instance, the advent of remote work arrangements has sparked a re-evaluation of office space needs, leading to uncertainties surrounding future demand. Similarly, shifts in consumer preferences and technological advancements have reshaped the retail landscape, impacting the viability of traditional brick-and-mortar establishments. The financial health of individual borrowers also plays a pivotal role in determining loan performance. Businesses experiencing financial distress, characterized by dwindling revenues or cash flow constraints, may find it increasingly difficult to service their debt obligations. Consequently, lenders are confronted with the arduous task of managing loans tied to properties with uncertain revenue streams and diminishing asset values. In response to these challenges, lenders have implemented rigorous risk management practices to safeguard their interests. This entails closely monitoring key metrics such as loan-to-value ratios and debt service coverage ratios, while actively engaging with borrowers to explore viable solutions. In cases where loans become distressed, lenders may opt for loan modifications, negotiate with borrowers, or pursue foreclosure as a last resort to mitigate losses. According to FDIC Chairman Martin Gruenberg, this surge in stressed loans, with a non-current rate of 4.11%, poses a significant downside risk for the banking industry. Gruenberg emphasized that this trend is of high priority for federal regulators overseeing the sector. The increase in non-current rates is primarily attributed to weakened demand for office space, resulting in softening property values. Additionally, higher interest rates are impacting the credit quality and refinancing capacity of office and other commercial real estate loans. Although the troubled commercial real estate loans have risen, it's important to note that the largest banks have relatively smaller exposure to this sector compared to regional banks. This is indicative of the industry's overall resilience, despite the challenges faced in the commercial real estate market. Chris Marinak, an analyst with Janney, underscores that while there is deterioration in commercial real estate portfolios, the concentration of total loans in this sector at major banks remains relatively small, which is a crucial factor in assessing the industry's strength. Moreover, industry giants like J.P. Morgan Chase & Co. have conducted thorough assessments of their commercial real estate portfolios and expressed confidence in their overall health. However, smaller banks continue to grapple with the impact of lower office real estate values on loan portfolios. Ranali Asaf, founder of Northwind Group, notes that while the largest banks are shielded to some extent due to diversification, regional and smaller banks face more significant challenges. He predicts winners and losers in the evolving landscape, but doesn't foresee a repeat of the global financial crisis. Robert Reaver, a partner at Cole Schatz, highlights mounting pressures in the commercial real estate sector, particularly with billions in loans due this year. He anticipates a wave of stress impacting banks overly invested in this troubled sector. In conclusion, while the banking industry grapples with challenges in commercial real estate, the overall health of major banks remains robust, although regional and smaller institutions face more significant hurdles. The sector is undergoing a period of upheaval, with winners and losers expected to emerge amidst ongoing pressures.